a couple questions came in. A couple people are asking if maybe we can show migration patterns. Maybe that's something we could do on another show, Greg, and talk about in and out migration. I think that's a great idea, great subject. Also,
what I can say to that is I can't show it, the map right now. What I can tell you is that it is universal that people are leaving California, New York, New Jersey, Connecticut, Illinois, and making their way to Arizona, Las Vegas, everything in Texas, Tennessee, Carolinas, Florida. Again, that was already happening. It's just happening faster now. And people are also going away from the city. I know I might have mentioned that, but I think it's worth reinforcing that those two trends are happening, and Houston is benefiting from both of them. And the outskirts of Houston is benefiting from both of them. So when you see what 250 grand gets you, which I think Noel's going to show you now, up in Cleveland, I think it's pretty amazing. Actually, it's on the screen now. Yep.
So a couple notes on that too. Where we're going right now is our RW Select website. The whole point of this is to educate and then show real opportunities. We're not in the big business. We are in the big business of selling real estate. That's what we do. We're not here just to schlep properties, but the fact is, as Greg pointed out earlier, the demand for single family homes across the board is unprecedented right now. It is unbelievable. That is pushing the yields down, but not out of reach. What it is doing is it's pushing some of the yields out of reach for some of the larger institutional funds because they're really yield driven. But when you're looking at these properties, we're really looking at the cash flow, and we're seeing a lot of 1031 exchange money, for example, coming out of New York, coming out of retail in office and multifamily, and coming into the single family rental space. And just to give a quick thing, Greg, I know we didn't touch on this as much, but there's some benefits to that, right? So you're looking at a house here that it's worth $252,000 now. What's it going to be worth in 10 years? Just based off the home value, not even talking about the income of the property. The income of the property is even, icing on the cake, or you could say the appreciation is icing on the cake, I guess.
That's an important point, that the institutional investors in this space, which were instrumental in the professionalization of SFR, if I heard it once, I heard it 50 times, that you can't count on appreciation, you only buy on yield. And I understand that because they're borrowing money at a certain rate. They have to deploy it and generate income. And the people that are deploying the capital to them, they're going to win on appreciation. Invitation Homes won on appreciation. The cash flow was how they raised the capital and then gave them the staying power to wait for that appreciation. But as smaller investors, you have to be thinking about both yield and appreciation. Otherwise, this is not a 4.5% or 5% investment. It's a 10 or 12% investment because it's got yield and it's got appreciation. And if you're looking to build wealth in a household, that's the combination that you need.
And when we're looking at the yields on these, for example, I'm going to pull this one up here. We're looking at what we call the yield on cost. It's going to take a second since we're pulling a lot of bandwidth. So the yield on cost is just what is the yield, cash on cash, you buy the house today. That yield isn't taking into account the appreciation. It's not taking into account your tax advantages, such as cost segregation, which can increase the yield up to 3 to 4 points in the first 4 or 5 years. So there's a lot of things that we're not experts on that we'll bring some people on in the future to talk about those things, especially about the cost segregation. But we're looking at just the yield on cost and the cash flow of that property. You take into account the market, the appreciation of the market, your tax benefits, things like that. You're going to have a rate of return that is much, much higher. Most of the time when a fund looks at buying a property, on their back end model, it's different. But when they look at buying a property, they're just looking at the yield on cost. And if they need to hit a 6% yield, they've got to hit a 6% yield. So they're not buying that property if it's at F5.5. But that's leaving an opportunity for an investor to come in and buy and benefit from that appreciation because you wait till next year, you're not going to benefit from the appreciation from this year to next year.
Let me jump in now, because there are a lot of people missing a lot of great investments because they pay attention to yield only and they don't have a good way of forecasting the appreciation rate. And so if you did that, here's a list of the cities you didn't invest in the last 10 years. Denver, Colorado, Washington, D.C. suburbs, Raleigh, North Carolina, Austin, Texas. The list of markets that are off your list now: Nashville, Tennessee, Charlotte, North Carolina, off your list. Why? Because they dipped down into the low 5s or high 4s in terms of yield, But if you're a small investor and you're not locked onto a strategy that you use to raise capital, and you're looking at having this investment plan coalesce over time to create wealth, what you're doing, for example, in Cleveland, you're looking at this thing through the prism of elapsed time. What is it now? All right. Yield on cost now is, I think, mid fours to high fours on these things. That is not setting the world on fire. Okay. It's better than you're going to get with a bond, but it's not setting the world on fire. But there's 6% appreciation properties. That's been the average over the last 20 years, has been 6%. It's been much more than I told you, 61% in 5 years. So we can't guarantee any of that. All right. But what you're doing here is trying to pick winners. And the picking winners is, what can you do if demand in that whole northern sort of exurb of Houston is catching fire right now because of the things we talked about. And if Cleveland, which was in the middle of nowhere before, is now in the center of everything for certain people, how long does it take you to push your rent up a little bit at a time until that property that you bought for $235,000 and was yielding sub 5 is now yielding north of 5, north of 5.5, north of 6 over time? You build your way to it. A lot of property managers don't raise the rents with the appreciation of the market. If your house got more valuable by a factor of 6%, it became 6% more valuable in a year, your rent theoretically can go as high as that in the following year, or at least in the trailing years. And so we've gotten really good as a company at knowing what the rent should be and not just phoning that in. A lot of people just phone it in. I've done it myself as a landlord. They're happy there. Just renew the lease, bump it $25 when I should have bumped it $75. And after a couple of leases, if I did that, I would have made it, a completely different picture. So I learned my lesson on that. But to Noel's point, you look at this thing of what are you going to do over the first 5 years of owning this property to make it yield a higher number and have that all happen while the property is appreciating at an outsized pace.
Yeah, it's interesting because we're dealing with lately in the single family rental space investors, a lot more commercial real estate investors coming in, and that appreciation that we deal with in single family rental and single family homes is a little bit foreign to them because they're really looking at, okay, what is the cap rate in a market? How can we increase rents? And that's it, right? Well, you've got a dual purpose here with a single family rental that you can benefit from the appreciation from the broader housing market and also benefit from the appreciation of your rent. And beyond all the tax benefits and things like that. I've just been scrolling through this a little bit to kind of show this property. But so this is a property that cash flows $10,000 a year at a 4.4% yield. That's just your cash on cash. That's not talking about that appreciation and what you're going to get a bump. And so a lot of people talk about, well, how long do you need to own to really make it worthwhile? My opinion, and Greg may think different or the same, is that you need to at least own for 5 years. You're looking at something that after 5 years, if you start looking at your cash flow and your appreciation and your equity, it starts really getting more interesting at year 5. I mean, year 5, you've got $11,500 in cash flow, and your equity, you're looking at a value of a house that you bought for $230,000 is worth $310,000. And that starts to mushroom out. This is not over the years, this is not let's buy now, hope the market appreciates 10% or 7% every year, which it probably won't. If you look at the trend line, it's what, Greg? 4%.
3.5 is the national average.
3.5 is the national average.
When you see that's really noteworthy. And again, these things play out, right? So we've been doing this for more than 10 years, looking at these factors of migration patterns. I like to call it people watching, right? This all ties back to shelter over families. And if you could get a feel for what they're doing and why, and will it continue, which is what this is all about, we've been able to pick winning markets very accurately over a long period of time. So we're very confident in this. And so what I want to do is we're going to jump over to the next thing because we're 30 minutes in right now.
Okay.
Alabama.
So I do want to point out a couple of things really quick on this. In here is a calculator. You can play around with the numbers. We have the actual taxes based on the current value, or the purchase price of the home based on the current tax rate. You don't know what the taxes are going to be in the future, but you can calculate them for currently. We have pretty low management and maintenance costs in here because this is a new construction home that comes with, and most all of these homes, or all of them, will come with a builder warranty that warranties the construction of the house, the guts of the house, and then you have warranties on all your appliances and mechanicals and all of those things. So that greatly reduces your maintenance costs, and you pretty much have zero deferred maintenance for the first 5 or more years. And then you're going to have very low upkeep of these homes. You can always have issues with tenants and things like that. And there's some great products out there that protect you for any damage that a tenant does. And so I always suggest to do your research on that, and we can talk about that another time. But you can be pretty close to worry-free in a house like this with very minimal repairs and maintenance issues for the first 3 to 5 years. And we're taking these numbers from our institutional investors and how they underwrite these homes.